AI can disrupt previously held modes in terms of investing. Much more thinking has to be put into underwriting what is a mode and how long that mode could last. How I like to think about it is the framework I use is I think that that's 3 pillars: data, insights, and distribution.
And I was interested to see how you also teach about investment memos, how to actually write that, because I feel like sometimes it's great to do all the analysis and have the best ideas in the world, but how do you actually present that in a compelling way?
I think temperament is critical. Investing, to be disciplined, patient, to wait for the stock price to get to levels that is a good price to invest, and daring to go against the consensus.
Welcome to the 𝐻𝐞𝐈𝐶 MBA Superconnector podcast. My name is Stephen Shi, and I'm the Associate Dean of our MBA program. In today's installment of the Superconnector podcast, I speak with Leonie Fung. Leonie is the CEO of Overlook Investments. Overlook is an Asia-focused fund that invests in publicly listed companies. Prior to Overlook, Leonie worked with Goldman Sachs, the Carlyle Group, Scion Capital, Lone Pine Capital, and the Jancor Partners. At Scion Capital, she worked closely with Michael Burry, who you may remember from the film The Big Short and his early recognition of the U.S. subprime crisis. Leonie serves on the investment committee of Oxford's Balliol College and the Hong Kong SFC Public Shareholders Group. She has also served on the investment committee of the Nature Conservancy. I am very grateful that she makes time to teach a course on value investing to our MBA students each year. In this interview, Leonie and I talk about her investment career, how she thinks about leading Overlook Investments as CEO, how she sees AI changing competitive moats for companies, and changing the investment process for investment firms, and why she makes time to teach at 𝐻𝐞/UST. We also get into the soft stuff. What are the people aspects of investing that can be the make or break, even if there's no numbers involved? I learned a lot from this conversation, and I hope you do too. Leonie, great to have you join our podcast today, and looking forward to having a chance to talk more about your investment career and your teaching at 𝐻𝐞/UST.
Pleasure. Thank you for having me.
So you've had a very long and successful career in investing. I'm curious, how did you get interested in the field? How did you get started?
It probably comes from my father. So my father, by day, he runs a chemical company, but he's very engaged with the markets at night. And I remember, during the conversations, he has been an early investor in many high growth tech names. So a lot of conversations at the time was why he thought these companies were good. Why does he think that they can grow so quickly? So I think he has actually been a very good investor, but what he wasn't very good at was he wasn't very good at explaining his concepts or to articulate kind of like valuation and how to think about intrinsic value. He did teach me a couple of things. Like, for example, he told me about the concept of negative working capital when he invested in Amazon. And as a child, that was interesting. So I think when I thought about a career, I just thought that being part of an investment firm where I could learn in a more structured way to kind of like think about how to spot these high growth potential, but to also think more carefully about valuation and when is the right price to buy and sell. I thought that would be a good learning. So that was, I guess, to your question, how I entered the investment management business.
And so you studied at Oxford and then did your MBA also at Harvard Business School.
Yes.
Worked at Goldman Sachs and Carlyle early in your career. Can you share with us, how did you make your decisions? Or there's some key decisions, for example, why investing in Asia versus staying in the US, and why moving away from the huge institutions of Goldman or Carlyle and working in the investment firms that you've worked in?
I think the first major switch was going from banking, which I started off at post-university. And I think that the truth on that is that the consulting firms and the investment banking firms were very active recruiting on campus. I studied engineering and economics, and I thought that, at the time doing A was a great learning experience, good exposure, and I got all of that. So really enjoyed my time at Goldman's. And the move to Carlyle was 2 years after Goldman. So I moved to Carlyle, and that was my journey into investing. Really enjoyed investing in private equity, but it got to a stage where it's either trying to go to B school now or never. So I decided that I wanted to experience the US education of B school. So I went to B school. And it was during business school that I had the opportunity to intern with Michael Burry at Scion Capital. At that time, he certainly was not as famous as he is now. I wrote him out of the blue, got the internship, which led to a full-time offer. And I think that was the other major switch in the career. Up until then, I had been, as you said, in more traditional big firms. And at B school, I also had offers from other bigger, more traditional firms to go to after graduating. But out of, I guess, loyalty, and also because I really respected Mike as an investor, I decided to rejoin him after B school.
Yeah.
Truth be told, in the first few months after rejoining him, I did think that I had made a severe career mistake, because this was in 2006. He was betting against the housing bubble, but at the time it wasn't working. He faced redemption pressures. In fact, I was in the office when some famous investor came in to wanted to redeem. There were angry conversations. And I did think that, my gosh, I just rejoined, and would I still have a job? And it was a tense atmosphere. But on hindsight, I would say that this whole journey and looking back, I think that it taught me that listening to your instincts and trusting your instincts on people help, because I rejoined because of loyalty, because I respected Mike as an investor. And he was very fair and generous in sharing with us, his employees. So that led me to rejoin him. I also made very good friendships with my other colleagues at the time that I still keep in touch with. So I think that was the lesson. But to your question, that was the other main switch from going from a more traditional path to a very non-traditional path at a time.
And so you've worked both with Scion and Lone Pine, which have different investing styles. Can you share a bit about the differences and how you feel that's influenced you?
Certainly. My time at Scion and at Lone Pine has also helped me think about what resonates with me more, because I think that my learning was that even within fundamental investing, there are different ways to express that. So at Scion, Michael Burry, it was more, I would say, classic deep value, where you really buy contrarian ideas. And Mike did not focus as much on corporate governance. He felt that if you buy something at a very discounted price to intrinsic value, you could make good returns from that. However, at Lone Pine, corporate governance, capital allocation, reinvestment risk, these are all critical. And at Lone Pine, there was a real focus on having to meet management of the companies that we invest in. Whereas at Scion, it was the opposite. Mike felt that meeting management would cloud and taint his views. And I think the lesson that I learned from that is sometimes you have to figure out what is your flair and what works for you. So for example, if you feel that you are able to get more information and you're good at reading people, then meeting management, getting further insights, it's helpful, and that should be complementary to your investment process. But conversely, if you think that meeting people could lead you down the wrong path, or you might even end up pissing off people with some of your questions, then maybe that's not something that you should do. So that was my experience.
It's great to see that range of different experiences coming together. And you're now with Overlook, CEO of Overlook Capital. You joined Overlook in 2015.
Yes.
How did you make your decision to join Overlook, and what's kept you there for the past decade?
So the opportunity came through a headhunter, but the whole get to know you process, interview process took, a long time. But I think during that process, I really understood how Overlook invests. And what resonated with me was because prior to Overlook, I was doing long short global equity. And at Overlook, a lot of the names that Overlook owned or has owned before were names that I had looked at or initiated at my former firm. So I felt that on the long side, there was already a very aligned investment philosophy. I was also impressed that despite very strong returns, Overlook had a very low profile amongst the investment community. And I realized that they had purposely kept a low profile. But actually, when you talk to the portfolio companies, I realized that they have built extremely deep relationships. So that resonated with me. And also, I think sometimes timing is key. I was a new mother at the time. So I felt that just doing long only, Asia only was good from a sustainability of lifestyle basis rather than doing global long short.
Sure. Wow. Okay. And Overlook. So I was starting to read the book that you had published, The Model, and it's fascinating to see how the firm has delivered double digits compound growth annually for more than 30 years. And this has been, all sorts of economic environments. And those of us who have been working here in Asia for that period, it's, lots of ups and downs. What are the most important reasons you would say for a firm's success over such a long time?
Say that it is discipline in the investment process, and also discipline on business practices. So on the investment process, it's very simple. We run a concentrated portfolio of 22 to 24 names. So we're looking for longevity businesses. And when we say discipline, one has to be very disciplined on valuation, because sometimes they're great businesses, but if you buy at the wrong valuation and you're not disciplined about valuation, then it might not be a good stock to own. So I think that just being very disciplined and trying to find good companies, back the right management, and have the patience to wait for the stock price to get to the levels that you want. I think that is important, that discipline. And also the discipline not to trade too much or react to news, because news flow, that's just news flow, abundant news. So having the discipline to not react to things, sometimes not doing anything is a discipline. And on the business practice, I would say that it is also being disciplined in not in just focusing on what you know best. So for many years, we just run one fund. We have resisted, investing in so-called new markets or setting up new funds. In fact, we return capital to investors after good years because we're not planning to be the largest firm in Asia. We get more fulfilled by generating good returns for investors. I think that discipline of doing what we believe is the best for our investors rather than doing things that enrich the employees is what I said, discipline in the business practices.
Yeah, so sticking to the core business, what you know how to do well.
Yes.
And I was curious to hear you talk about the discipline of not reacting too much to the news. And that seems to be something where I talk to investors and sometimes they're saying they're having trouble keeping up with all the news around the world now.
Yes.
Right? Polymarket, X, everything's, trying to monitor all of that.
Yes.
How do you strike the balance between keeping, up to date with all the perspectives happening versus your longer term strategy?
I think first of all, it's defining and preserving the culture of Overlook. So I think that when we recruit people, the temperament is very important. So nothing wrong with, say, if you are a trader, sometimes if that's what you're good at and you can repeatedly generate good profits, then sure, go down that line of trading. But at Overlook, we typically find companies that we want to own for a long time. And hence, we don't trade much. And we're looking for people to join us where they have that same temperament of not feeling like they need to keep pushing ideas into the portfolio or taking easy profits. Because sometimes when you invest in a company, selling too soon is also not a good thing. You have to have the discipline to be able to hold on to your winners. The news, and even monthly, daily news. So I think having the temperament to not be too happy when things are going well, but not be too depressed. So I think that is a temperament that we look for. And in terms of my own methods to not be distracted, I don't turn on my Bloomberg. I have a Bloomberg machine in my office, but I don't turn it on for most of the day. And I think you have to create ways. And I create time slots in my days to do deep thinking so that I don't check my email or don't get disturbed during that time. So I think that in a time where attention span is short and many news, we have to create these self-boundaries.
Yes. And how does that relate to ESG? So that's a topic that I know you've worked on, you've advised companies on.
Yes.
So how does that fit in with your investing? And are there ways that you've influenced companies on this area?
The narrative on ESG has shifted, and currently there's a lot of skepticism around ESG. And actually, even during the time when we started ESG in Asia was still definitely not advanced in Europe. But in the end, for us, it's always about creating long-term value. So for ESG, we are not focused on box ticking. So for example, if it's just box ticking on whether you meet certain ESG matrix, that's not what we focus on. We try to focus on things that truly matter in the E, the S, and G. So G, governance. We think that, for example, alignment of interests with minority shareholders is critical to investing. We advise our companies on what they should do to make sure that they continue to be aligned with minority shareholders. And this relates to corporate governance, capital allocation. So I think that is key. On environmental side, we're not focusing on every single matrix within environment. We focus on carbon emissions and it's science-based. So we work with companies to tell them that for your long-term benefit for the companies themselves, it is good to be part of the solution rather than to be part of a problem. Hence, we have shown the companies that sometimes when they focus on the right matrix, it is good for their businesses as well. So for example, not to name, companies, but for some of our portfolio companies, we were early on in telling them that they need to diversify the energy sources beyond a certain country. And they should also consider renewable energy sources because their clients, such as Apple and all that, will be demanding that. So in a way, they need to do this for their own good in the future because the clients will be looking at these things when the clients evaluate suppliers. So to your question, we're not trying to cover everything, but we try to cover things that really matter.
Yeah, and it feels like that makes sense when you're doing long-term investing.
Yes.
And being able to take that perspective on the long term. On the long term as well, there's the question of investing in China, which, certainly, the news changes every day. How do you think about investing in China and thinking about everything, economic fundamentals, but also the relationship with the US and China, regulatory changes, and all of that type of stuff? How do you manage that?
Like you said, there are a lot of complexities with geopolitics, decoupling, etc. But I prefer to focus on the opportunities. It's precisely because of these concerns that the China market and a lot of Chinese companies have derated, and they are trading at significant discount to their US peers, despite generating actually similar growth rates, in some cases superior growth rates to their US peers, despite having even better operating matrix. So actually, even in the class that I teach, I use some of these examples. So for example, in 2003, bear markets, 2024, 2025, I use examples in China and in Asia to illustrate how some leading companies could, just because of narrative change, suddenly be trading at just 10 times PE, even though they're still growing very healthily. So to your question, I'll say that complexities certainly create investment opportunities, and it's up to investors to really figure out, are these good businesses for the long term to invest in? And now is the market giving us a very good time to buy these companies? And I would say that China is very important. Whether you are a business operator or an investor, we see that Chinese companies are extremely cost competitive and very innovative. So even if you're not an investor, you need to look at China because they probably will be taking share from your companies. Yeah. But to be a true question, I think there are definitely a lot of complexities which moves the narrative and cause share price to derate. But sometimes there's a disconnect between fundamentals and valuation.
And the other big question on the disconnect between fundamentals and valuations nowadays is with AI. Productivity booms, AI kind of affecting every industry.
Yes.
All sorts of companies. What's your view and what's your experience been on this, both with AI changing the competitiveness of companies you might invest in?
Yes.
As well as how is AI affecting, if at all, your own, investment processes and the ways you do your work?
I think AI is certainly changing and the developments are rapid. I think that how it plays out in investing is we have to think much more carefully about the modes of companies. I think AI can disrupt previously held modes in terms of investing. Much more thinking has to be put into underwriting what is a mode and how long the mode could last. How I like to think about it is the framework I use is, I think there are 3 pillars: data, insights, and distribution. So I think that if a company has proprietary data, or if it's able to have data that enables it to do analytics to then come up with better innovations, products and services that are good for their customers, that are ahead of their competitors, I think that will be a good use of AI. And there has to be a feedback loop as well. So for example, if you have the data and analytics to enable you to come up with superior services, and from the customer's usage of that services, if the feedback loop allows you to use that information to then further innovate, then I think that could be a sustainable source of advantage. I think obviously data is one thing, but insights, how do you come up with insights with the data, is also important. And I think that the third pillar, distribution, I think it's also an important advantage, because in a world where there's abundant information and attention span, it's like just very little attention to reach the customers in the first place, to reach the customers is an important thing. So I think about who actually reaches the customer, who actually owns the interface, And I think that if you have a strong distribution, that can also create network effects to get that data from customers when they use your product to then feedback to your team to use that data to further innovate. So I think that this will be the framework I use to kind of like evaluate whether a company has a moat and whether they could have a chance to have a sustainable moat.
And as you develop those type of frameworks or you think about evaluating companies against it, how are you using AI?
Sure. So we have 35 years of proprietary data. So a lot of that data of our meeting notes, our views on companies is sitting on our proprietary database. So I'm getting my colleagues in my data team to use AI to better draw insights from that proprietary data. So like I said, we have the data, the proprietary data. Now is using that for insights. So we use that data to help us prepare for meetings. And when we prepare for meetings with newer companies or industries, we also use AI, we integrate it into the investment research process. So I do think that if you use AI tools well, you could actually broaden your knowledge, but also go deeper. But if you use it unwisely, then you could just have breadth, but no depth, which is what we want to avoid.
Okay, fascinating. Let's talk a bit about the firm overall.
Sure.
So you're now CEO of Overlook, and you took over from a great founder of the business. As you think about the future of the firm, what are some of your top goals and priorities?
I think at a high level, the primary goal is quite straightforward. We want to continue delivering double-digit returns to our investors in line with the fundamental normalized growth of the portfolio, and to achieve this without taking bigger risks. So I think it's all about continuing to strengthen the process within the team. So one of my biggest priorities internally when I took on the role was to make sure that we truly have a repeatable process and to really be able to get the best ideas from my team members into the portfolio. I made a couple of changes, and I would say that when it comes to motivating the team to try to get best ideas into the portfolio, I think about it like a triangle. So I think if you think about alignment, communication, and motivation, I think that to have best performing team members, obviously you want them to be aligned. I think communication is very important within the team to give direct feedback, because as an example is that we don't buy new names that often. So if different team members pitch different ideas, sometimes their ideas might not end up in the portfolio. And having gone through the process myself from a junior analyst to where I am today, I feel that sometimes it's not so much about whether your idea makes it into the portfolio, but it's getting feedback. So I think the communication is important. I also like direct and more open communication. So something that I instilled was I got all team members to participate in the investment committee so that they could hear ideas that are being pitched by their colleagues. They also have a chance to ask questions. And I think that is motivating. They can have direct feedback. That's also part of communication. And then in the end, when the investment committee chooses to buy certain names, everyone has heard and have a better understanding as to why certain names made it into the portfolio and not. So that is on the internal side. And on the external side, I think that is increasing my job to ensure that communication with external parties, this would be more our investors, is very important as well. So my role here is helping our investors understand what's really happening in Asia beyond the headlines, because perception and reality, often there's a gap. And I think it's our job to bridge the gap with more transparency and clarity of information.
It's interesting to hear you talk about the communication and the alignment and explaining why some investments might get chosen or not get chosen for the investment committee. And I think it's got a lot of parallels with teaching. And, so we're very grateful that you take time to teach at 𝐻𝐭𝐞𝐨𝐧𝐢𝐞. You co-teach the fundamental value investing course along with Tian-Chu. So you've been teaching that even as, an active investor, as someone that's running a business as CEO. You're also sitting on the investment committee at your college at Oxford. You're with the SFC Public Shareholders Group. How do you make time for all of this? And, why is 𝐻𝐭𝐞𝐨𝐲 one of those things you make time for?
I think people will carve out time for things that truly matter to them, that they think is impactful. So the things that I get involved in are things that matter to me, that I believe in. And with regards to teaching, I do enjoy teaching and I find it very fulfilling. And it's actually complementary to my work. So I find that when I teach, it helps me communicate certain ideas better, and it helps me rethink like first principles, like, first principles of why certain businesses are good and to kind of see whether they turn out to be good stock investments. I think that is actually very invigorating as well, being, amongst younger people who have actually very good questions, and it keeps me sharp, like answering some of my students' questions. And it's incredibly fulfilling when I've now taught for 3 years. It's incredibly fulfilling to see some former students attend the classes again, even after they graduate, sure, because they said that they enjoy the class. And for some of them that came back to say that the class was helpful to them to get their internship or get their jobs, that is also very fulfilling. And the reason why we actually came up with this course is, so Tian and I have been good friends, and I think we have been good friends for a long time, and we always said that it would be quite good to come up with a course to teach together at some point. Yep. And when we think about this course, we thought about what would be helpful to us when we were students at that time. So, when I was interviewing for the jobs, at the time, there was no way to kind of help you think about, how do you really prepare for interviews? How do you really think about what is a good investment? I've read a lot about books, but we wanted to make the course practical. What is it? How do you analyze what is a good business? And then more importantly, how do you know what is intrinsic value? I think that when, as a student at the time, that was a question, like, how do you know what is intrinsic value so that when the share price moves against you, you don't feel afraid? And we wanted to share some of the practical elements as well, because sometimes value stocks can stay cheap for a long time. So how do you turn theory into reality, and how do you make it interactive so that students, after taking this course, can be prepared, if they're interested in the career esteem, be prepared to interview for a private equity job or for a public equity job. So this course bridges private equity and public equity, just because from my own experience, I did private equity and public equity. So I thought that this could be helpful for the student.
And a lot of what you're trying to do is value the companies and decide if it's...
Yes. And to make it interactive, so I would have live case studies, so the students get a chance to not just learn the theory, but to actually implement what they have learned into coming up with actual investment ideas. So we will go through a case study from analysis of a company to identifying intrinsic value, due diligence, so forth. But we will also give the students the chance to select whatever company they want and to go through that process and then to pitch it to Tian and myself as investment committee. And we'll give them direct feedback, in a way, a taste of what it would be like before they actually have a career in these real jobs.
And I was interested to see how you also teach about investment memos, how to actually write that, because I feel like sometimes it's great to do all the analysis and have the best ideas in the world, but how do you actually present that in a compelling way?
Yes.
What are some of the things related to the investment memo that you try to convey to the students?
Yes. So we also tell them that it's also the investment memo, and the depth and the length also differs, whether it's private equity versus public equity. And in the end, being succinct and just being to the point is most critical. So we emphasize that you don't have to, it's not the quantity. You have to grab the attention of the portfolio manager. So in a way, a lot of it is also communication. You might have a great idea, but if you're not communicating the idea in a succinct way, it might never even make it into the portfolio, because typically the portfolio manager of companies, they have short attention spans.
Yeah. And this is one of the paradoxes, right? I forgot who said it, but I would have written a shorter letter, but it would have taken me more time. And it's to get to that succinctness actually takes even more work.
Yes.
Than it does to write, a 100-page presentation or a 100-page report.
Yes. And what we try to really get is also to make sure that the students have really understood the takeaways of what we try to teach, because these days it's very easy to get AI to come up with a beautiful investment memo. So we structured the course so that there is a lot of Q&A where they have to present, and we will ask, as professors will ask them questions to make sure that they really understood the key points, as opposed to just getting AI to run an output.
Well, one of the other things that a lot of our students and our faculty operate at is the intersection of East and West. And if you think about value investing, are there differences in what you teach about investing in Asia, for example, than you might expect to see if someone were investing purely in North America or Europe?
I would say that in terms of the East and West, the analyzing what is a good business, that is similar. So assessing business quality, assessing modes, pricing power, Does the company generate high returns on invested capital? Can it sustain this? These are all similar, I would say, whether it's East or West companies. However, I think in Asia, what deserves more work and understanding is understanding the corporate structure in Asia. Because in Asia, typically founding families or entrepreneurs have a majority of the shares, and they might have many other listed companies or even private companies. There's a concept of parent company and listed company. So much more work has to be put into understanding the corporate structure and the incentives of the majority shareholders so that you are investing in the listed entity that is most aligned with the major shareholder so that you don't get the risk of being, having egregious actions harm you as a minority shareholder. So I would say that is the additional focus within Asia.
Okay. And going back to, you mentioned earlier, the idea of hiring for people with a certain temperament. As you think about value investing and teaching students about investing, there's a lot of personal characteristics in addition to the analysis of numbers, right? Whether it's patience or discipline or being contrarian or whatever it is, right? Or just, being able to have the ability to turn off your Bloomberg screen for most of the day. What are there ways that you try to teach some of these soft concepts in class? And how do you try to convey some of this type of advice to your students?
I think temperament is critical in investing, to be disciplined, patient, to wait for the stock price to get to levels that is a good price to invest, and daring to go against the consensus. So, it's easy to chase fat stocks and to pay ridiculous multiples, but to invest in out-of-favor companies, I think that you need to be contrarian. In terms of how we teach this in the classes, we went through real-life examples where the same company, just within 1 year, the share price, could be 50% higher, 50% lower, even though the fundamentals haven't changed. It's just based on a narrative change. So what we try to emphasize is the market sometimes, due to narrative change, would give you a chance to buy a company. And during the time when the stock derates, you really have to have the appetite to figure out, has the fundamentals really changed? Do you dare hold on to the stock? Do you dare buy more? So we use these real-life examples to show the students. And I also ask them to honestly consider their own personality. So we say that this course is on value investing because that's how Tian and I invest. But it doesn't mean that other forms of investing is not successful. So if one's personality to go for more momentum, if you're able to repeatedly trade in and out of stocks and do well, that's totally fine. That's one form of investing. But as a value investor, then, you have to have the temperament of being disciplined and contrarian.
Yeah, which is interesting. One of the themes that we talk a lot about in our program is innovation and entrepreneurship. And what you described as that contrarian ability is similar to what I talk to students about from entrepreneurship perspective. It's like the economist Joseph Schumpeter said, or wrote many years ago, how the entrepreneurs need to be able to do two things, right? One is to be able to perceive opportunities that can't be proved at the moment of decision, and also the ability to overcome social resistance to the change. And I think in this kind of value creation, whether it's investing or being an entrepreneur, you've got to have that conviction, that ability to say, that's what I think, and the temperament to go for it.
So some of the discussions that we have in classes to kind of probe them to think more outside the box and to be more contrarian is I try to encourage first principle thinking. Memory names, the memory sector has gone up a lot. And for the short term, these memory names could continue to go up. And there's a lot of positive reasons why memory names can continue to go out in a memory type cycle. But I encourage them to think about longer term, what needs to happen for these memory names to continue and what is already implicit in the expectations of these names. So for example, I get my students to build the models for the forecast. So I would challenge them saying that, yes, you are pitching this name, but based on your so-called analysis, your forecasts are actually even lower than what the street is expecting. So that is not going to work in practice, because if you are right, your stock would fall because the market is expecting even more buoyant numbers. So sometimes I get them to kind of rethink of like what is already implied in the share price.
Yeah. It really does require that extra thinking, extra research, extra conviction on these types of opportunities. Well, you're spending a lot of time with us. We appreciate that. You're educating the next generation of investors and business leaders in our classrooms. As we wrap up this podcast, what is the single most important piece of advice you would give to an 𝐻𝐭𝐞𝐄ST MBA student who wants to build a long and meaningful career in finance or business in Asia, and in a world that's being changed by all sorts of things as we speak, whether it's AI or geopolitics or new technologies and all of that? What's the piece of advice you would give to someone today?
I would say that invest more in relationships and not just skills. And to your question, if you are thinking of a career in Asia, whether it's finance or business, Asia is not just one single market. Yep. It's a collection of different countries with different different regulations, different capital markets. And I think relationships and building trust with key decision makers that could help one is very important. In fact, drawing from my own experience, even within teaching. So for one of my classes, I actually get a friend who is in private equity to come to have a live case study to enable the students to simulate what it is like bidding for a company. And I think, again, is the relationships and the friendships I have that enables me to request these friends to participate in and sit in on a 3.5-hour class. Yeah. So I think that in the end, in an AI world, information is abundant, but I think that communication, building trust would continue to be critical skills. So yeah, I'll say that continue to invest in relationships.
Thank you very much for taking time to speak with us today.
No, it's my pleasure to teach and be part of this 𝐻𝐭𝐞𝐄ST community.
Thanks for giving this podcast your attention. As Leonie pointed out, the battle for attention is becoming a key priority for many companies and for all of us as individuals. I was especially struck by Leonie's statement that she turns off her Bloomberg terminal for most of the day, and this is so she can think deeply. She only checks it at certain times and is not constantly on it. I don't use a Bloomberg terminal in my work, but I am also now thinking about how I can cut back on digital distractions during the day. Discipline to say no to a bad investment can be the same as saying no to a bad use of time. Our podcast is designed to give you a chance to engage in depth with our guests. We're not here to offer sound bites or clickbait or superficial hot takes. If you are interested in long-form podcasts and this in-depth approach appeals to you, please do follow this podcast and stay tuned for our next episode.